Hey everyone, welcome back on the channel. Today I'm going to talk a little bit about impermanent loss just to show you a practical example how it plays out. For that reason, I'm using Crystal. This is an overall great tool for managing and even finding trending liquidity pools in multiple blockchains. If you want to check it out, I'll leave a link under in the description with the full walkthrough of Crystal, and I even did another on the mobile app, but they both work pretty much the same. But what I'm going to talk about a little bit here is impermanent loss, and I'm going to show you this example here of the liquidity. So there's current and there's hodl. This is how they calculate the impermanent loss. So you see, impermanent loss here is almost $1. And why is that? So hodl is when I first deposited. So they lock those numbers just for the sake of comparing. So if I would be holding these in my wallet instead of depositing into the pool, I would be holding this amount of ETH, or this amount of ETH worth this in dollars, and this amount of Miggles worth this in dollars, right? And you see that the current percentage that I own of both tokens, it's vastly different. I have 51% now of Ethereum, so I have more than I did when I opened the position, and I have 49% worth of Miggles, which is also vastly different from the 72% I had initially. So that's because the pool is, when we're talking about concentrated liquidity pools, you probably saw this here and there, they're labeled as AMM, which stands for Automated Market Makers. This means that the pool automates the whole process of finding a balance. So for example, if Ethereum goes up in price, they will sell Ethereum and buy more Miggles because they need to level things out. That's the ultimate goal of liquidity pools, and that's why eventually you will suffer impermanent loss. If you play this game the long term, you will suffer impermanent loss. But that's not necessarily bad, because the end goal here is generate fees. And you can see here from the position, both the unclaimed and the claim, they vastly outweigh the impermanent loss. But that's also because I held through a couple months where Miggles went down in price, and if I had sold my position back then, this impermanent loss would be much higher. It would probably have wiped out 50%, if not more, of my initial investment. But that's just the same mindset of when you're, for example, trading and you're buying a token and then the token goes down, and if you sell when it goes down, you sell at a loss. And that's the same mindset here for concentrated liquidity pools. And that's also why in many of my other videos you will see me advocating for beginners especially to provide liquidity to blue chip, and that is because likely you will have much more conviction to hold those positions, because we're talking about blue chips, we're talking about Bitcoin, Ethereum, stuff that will not drop 50% overnight. You will not panic, and in crypto, markets are extremely volatile. If you are not prone to risk, stay away from it. If you are testing waters, start with blue chip assets, because those will be much more solid. But anyways, impermanent loss here means just that if today I would take my funds out of this liquidity pool, I would close my position, the liquidity that I currently own would be worth $1 less than when I first deposited. So that's where this impermanent loss comes from. So if instead of providing liquidity, I would just have left these tokens worth of Ethereum and these worth of Miggles sit on my wallet, they would be worth almost $1 more than what they are right now. The thing is that when you're providing liquidity, you do it for the fees. You know that it will generate fees. So you got to know which ranges you will set up, and while you are in those ranges, you will generate fees. And in the long term, or even on the short term, but the end goal is those fees that you generate outweigh the potential cost of impermanent loss. Because right now, if I would close my position, yes, I would have this amount of Miggles, which are much lesser than when I started. I started with 535. Now we're down to 361. So I started with 72% of my position being worth or being composed by Miggles, and now it's only 49. And this also goes to show that depending on what you want to do, this can be a really good way to automate your trades. But I'm not going to go on that route on this video. This is supposed to be more of a simple explanation of impermanent loss. So right now, if I would close my position, I would end up withdrawing this amount of Miggles and this amount of Ethereum, which again has a market value lower than my initial, so I would realize impermanent loss. That's the thing. It only becomes permanent when you sell. Until then, it's impermanent. But even if I would sell, again, I would have been farly outweighing that risk because of the fees that I generated. Now, this is an example where things go right, but I can tell you that easily a couple of months ago, Miggle's price was down, and if I would be looking at the same screen, you would see an impermanent loss here of probably 50%, if not more, of my initial deposit. You can see up here my initial deposit was a little over $60, and probably the position was worth, during those months I mentioned, it was probably worth what, $20-30 the most. So if I would have sold back then, I would have realized impermanent loss. So these things are mostly depending on market conditions, and if you play this medium to long term, you will see at some point, you'll look at the screen and you will see impermanent loss there, but the end game is collecting fees. So right now the position is fairly balanced. I mean, it's 50-50, but also things in the future might change. If Miggle's price goes down, and this is worst case scenario, if it goes down enough, I'm going to be out of range on the downside. I will stop generating fees and my whole position will be worth 100% Miggles. Ethereum is going to be 0%. So that's also a part of the risk of providing liquidity. When the price goes down, I will be left holding the weakest token in with full exposure, basically. All my position turns into Miggles. On the other end, if Miggle's price just skyrockets, it goes on the upside and it goes out of my range, but on the upside, my whole liquidity becomes Ethereum, 100% Ethereum. So in practical terms, all of the Miggles tokens are going to be sold for Ethereum. At that point, also, I mean, I guess we could call it impermanent gains because the position would be worth much more. And by the way, since we are at it, you see it's pretty much 50-50, so it's very much balanced liquidity we are right now. That's because the current price, you see the current price of Miggles per Ethereum. So how many Miggles are necessary to buy one Ethereum, the most valuable coin in the pair? It's pretty much in the middle of my set range, in the minimum and the maximum. That's why you're seeing here this very distributed liquidity in between Ethereum and Miggles. And if, for example, Miggles starts to outperform Ethereum, and in that case you will need less Miggles, less amount of Miggles to buy one Ethereum because Miggles becomes more valuable, in that case you will see that the current liquidity, this would start to shrink. My holdings of Miggles would start to shrink and my holdings of Ethereum would start to go up until 100%. And they reach 100% if Miggles price goes out of my range on the upside. So goes above this level here, this amount. And also the opposite is also true. If Miggles price starts to go down and you see the Miggles per ETH starting to increase because it loses value, and since it does lose value, you now need more Miggles to buy one Ethereum, then the liquidity distribution here would start to grow and grow and grow to be 100% Miggles. So if I go out of range on the downside, I'll be left holding 100% worth of Miggles, 0% worth of Ethereum, and now I'm just potentially holding a full bag of Miggles that can go further down in price, and that's going to be a risk. So there's definitely going to be a lot of strategies that you can set in to manage this, but usually what I do see many beginners do is selling out because they see price go down, they panic, they don't think that it might bounce back up. But that's also why I mentioned you should start, especially as a complete beginner, with providing liquidity to blue chip assets. likely you will not mind holding those during down markets, during price dips that get you out of range, because that's also another thing when providing liquidity. When you go out of range on the up or downside, it doesn't really matter. As long as you go out of range, you stop generating fees. But anyways, if you have any questions, let me know in the comments. I made this quick one just to show you what impermanent loss is and why you shouldn't really pay all that much attention to it when you are holding with conviction. Again, I'm not saying you to open a position like this with Meagles. By the way, this is on base, but it's a meme coin. This is not something that I would advise people to do, especially complete beginners. You should start with blue chip assets, learn from there. Don't even automate it, and you can also automate stuff here with Crystal, but don't even start trying out with automation before you understand at least the basics of providing liquidity. You gotta understand how things work, how the percentages that are on the pool shift depending on what prices do, how the markets go, understand the risks, all of that stuff. I did plenty of videos already about that. I'll link all of those down below if you want to check it. But anyways, to sum it up, this is what you need to know about impermanent loss. It's the difference between holding what you had initially when you opened the position versus what is the current liquidity that you are holding, and that difference will be impermanent loss or impermanent gain, because yeah, I guess we can call it that. But once again, you only realize this impermanent loss when you sell. Until then, it's just a number on the screen. You might not be generating fees or anything, but it's just a number. If you don't sell, you don't realize, you don't lock it in. And if you're wondering about the fees are always there for the taking. They are going to be reserved for you as liquidity provider. When you claim, they go to your wallet. If you do not claim, they'll sit there waiting for whenever you decide to come and claim those, okay? So I hope this helped you out. Alright guys, if you have any questions, let me know in the comments. I'll get back to you. If you want to know more and learn about yield farming, liquidity pools, the basics and beyond, I can vouch for the Underdog Investor Group. I'll leave their affiliate link down in the description and in the comments for you to check out if you wanna. Using my link, you'll get 20% off on your first month, and they are basically a yield farming dedicated community. You get free courses. You can also get one-on-one training. And if you took value from the video, you know the drill, like and subscribe. We're all about bringing crypto knowledge to the everyday user, helping people to onboard, where to buy, options to invest with DeFi. If you're interested in any of that, I think you'll get plenty of value here on the channel. I'm going to wrap this one up. Thank you for watching. Take care. I'll see you on the next one.